Now in today's video I want to dive into PayPal and explore why it is the best company you can possibly buy at this current time. Now jumping to my stock valuation spreadsheet, we'll plug in the PayPal ticker PYPL and all the metrics will show up automatically. Now the first thing we can see is that PayPal currently doesn't pay out any dividend whatsoever, and I am actually very happy about that, and I will explain why a bit later in the video. Now the current trading price of the company is sitting at $64 and the analysts predict a price of $71.38. I don't really agree with that. I think that the company will go much higher than that in the next 1 to 2 years. Now the beta of the company is sitting at 1.41, which means that it is quite more volatile than the S&P 500. Now moving to the 9-pillar analysis, the first thing we can see is that basically everything is in the green except for the 5-year PE ratio, which is sitting at 36.79, and the 5-year PE ratio is the average of the PE ratio over the past 5 years. Now we generally want this to be sitting below 22.5, which would mean that the company is not overvalued compared to their earnings. But if we actually scroll down to the financials, and for those of you who have watched my channel before, I have actually changed the financials, so in this video you can have a look through what has changed. We can actually see that the PE ratio from 2019 to 2023 has been decreasing very steadily, and over the past 2 years it has been sitting at about 16, which is great. Now scrolling further down, we can see that the revenue and the net income of PayPal have both been increasing very steadily since 2019. As we can see, the trend lines, the one in the red, shows the steady increase of the revenue and net income. Now scrolling further down, we can see that the company is actually buying back shares. Now when a company is buying back shares, it is a good sign to me for two reasons. The first one being that the company believes in itself, and the second one being that the more shares they buy back, the larger percentage of the company I own. So say I have a large pie and I own 5% of that pie. Now say a company buys back half of the pie, half of their shares. It would mean that now I own 10% of that pie. Now seeing the free cash flow is also increasing quite steadily. The company doesn't currently pay out any dividends, that's why this graph is empty. Now we can see that the long-term liabilities are actually increasing, and increased from about 7.5 billion to about 12.5 billion in 2023. Now scrolling back up to the 9 pillars, so we can see that the long-term liabilities over the 5-year free cash flow is currently sitting at 0.55, which means that the company can pay off most of their long-term liabilities within 3 to 2 years using their free cash flow. And that's also why I am happy that the company isn't paying any dividends, as dividends are paid from free cash flow, long-term liabilities are also paid from free cash flow, and as the company doesn't pay out any dividends, they have more money to pay off their long-term liabilities and buy back shares, as we can see right here. Now moving back down, the earnings per share are increasing as well, increasing from about 2 to about 3.84 in 2023, and the free cash flow per share is increasing as well. Now this is probably one of the main reasons why I think PayPal is undervalued. As we currently saw, all of their metrics are growing from 2019 to 2023. Everything is growing, everything is going well. But if we have a look back at the stock screener, we can see that from 2019 to 2023, the company has dropped in price significantly. Now that we have looked at the company internally, we can go and calculate its intrinsic value using our 4 valuation methods. Now also I want to remind you, if you do like these spreadsheets and would like to download them for yourselves so you can value any company, you can do so at my Patreon, which I have pinned in the link in the description. Now looking at the first formula, the Grams formula, we take the trailing earnings per share, the base PE of the company, the 5-year growth estimate, the growth rate multiplier, and the average yield on AA Corporation bonds, and divide everything by the short-term average yield on AA Corporation bonds, sitting at about 3.58, and get an intrinsic value of $96.91, about 33% higher than the current trading price of the company. Now we can move to our next valuation model, which is the discounted cash flow model. And here we take the free cash flow over the past 5 years and calculate the average growth rate to be sitting at 9.76%. We then have a look at the analyst growth rate projection sitting at 8.68% per year over the next 5 years. And using these two metrics and our previous knowledge from the 9-pillar analysis and from the research we have to do in the back end by ourselves, I'll calculate the growth rate of about 9% over the next 10 years. Now, using the discount rate, which is essentially the rate of return I want for this company, I'll calculate the present value of all that future free cash flow. I then sum all that up, add any cash and cash equivalents, subtract total debt, and get an equity value, which I divide by the shares outstanding and get an intrinsic value of $97.01. Very similar to the intrinsic value we got in our grams formula. Now moving to our next valuation model, the multiples valuation model, and here we'll compare PayPal to companies which operate in the same sector and have very similar structures. So one company we can compare PayPal to is FI, and we can actually compare PayPal to GPN as well. And when we plug that in, we can see we take these companies' current stock prices and divide by their earnings per share to get their current PE ratios. We then average out these PE ratios and multiply by earnings per share of PayPal to get the intrinsic value to be sitting at $19.88. Now, normally we would also do our dividend discount model, but as PayPal doesn't pay out any dividends, we will skip this and arrive straight to the ultimate intrinsic value. And here we will average out our grams valuation, multiples valuation, and the dividend discount model, the discounted cash flow valuation, and get an intrinsic value of $97.60, which is 50% higher than the current trading price of the company. Now, if we plug in a margin of safety of say 30%, we would still get an acceptable buy price at $68.32. Now what we can also do is plug in PayPal to our Lynch model, to which I did a guide about 2 days ago, so if you want to, you can go check that out after this video. Here we take the earnings per share growth, don't add any dividend yield as PayPal doesn't pay any dividends, and divide it by the PE ratio. And we get a Lynch decimal of 1.35. We then multiply that by the current stock price of the company and get an intrinsic value of $87.72, which is again higher than the current trading price of that company, of PayPal. Now, as we saw, all the models suggest that PayPal is currently undervalued and that its intrinsic value is sitting at about $97. Now, you should not go out and buy PayPal just because I said so. Personally, I do own PayPal in my personal portfolio. I was buying it since it was sitting at $80 per share. I'm just simply trying to teach you guys a process of how to value stocks. Now, if you think that it isn't a good idea to buy PayPal at its current trading price, please let me know down in the comments why you think that. Also, if you enjoyed this video, make sure to leave a like and subscribe as it really helps me out.